Unless you've been living under a rock, you'll have heard the term index fund thrown about in the past few years. But how do you know which one to invest in when there's literally thousands out there to choose from? I put together a list of my favorite 8, which include a range of different sizes, asset class, and region. For the purpose of this video, I'm going to use exchange traded products rather than the actual index. There are slight differences, which we won't get into now, but essentially exchange traded funds are going to be more accessible to the majority of people. So let's get into it. So coming in at number 8 is the iShares Physical Gold ETC. This has an expense ratio of 0.12%. Now the expense ratio is simply just the fee that you pay to invest into the fund. You don't actually pay this directly, it's taken from the fund already. So when you see the price of the fund, it's already had that expense ratio taken out. This fund allows you to get direct exposure to gold prices without having to hold physical gold. So rather than you having to go out and purchase and store gold yourself, you can buy shares in this fund. The fund itself will then hold physical gold bullion in secure vaults. So it allows investors to participate in the potential upsides of gold price movements without the complexities of physical storage. The way to look at gold is as a safe haven asset during times of economic uncertainty. So it's very much a long-term investment because annualized returns are going to vary significantly, but it gives you a layer of diversification because there's generally a low correlation between your typical equities and bonds. It also gives you a bit of an inflation hedge as well because it tends to perform well when inflation or currency devaluation is a concern. In terms of the future, it's likely to remain a refuge during times of economic and geopolitical instability, and its future performance is going to depend on global economic conditions, inflation trends, and just general investor sentiment towards traditional currencies. And if that fund's not exciting enough for you, this next one definitely will. So coming in at number 7 is the iShares Nasdaq 100 UCITS ETF. This has an expense ratio of 0.33%. The fund tracks the largest 100 non-financial companies in the Nasdaq stock market. It's heavily weighted towards technology, consumer services, and innovative industries. Over the past decade, the Nasdaq 100 has well outperformed broader market indices, being propelled by the explosive growth in the leading tech companies, also known as the Magnificent Seven. But that explosive growth hasn't been without high volatility, which tends to be a theme of tech-centric investments. So if you want to benefit from trends in technology and disruptive industries, then this fund is for you. But bear in mind that a lot is already priced into the fund. So people are banking on that performance continuing. So if you want to capture that potential future performance, just go into it open-minded about the potential volatility that comes with it. Next, we have the most popular ETF in the list, and it's the Vanguard S&P 500 UCITS ETF. This has an expense ratio of 0.07%, making it the cheapest on the list as well. This fund tracks the largest 500 companies in the US. It's weighted by market cap, which means the bigger the company, the bigger the weighting in the fund. It's a hugely popular fund, mainly down to historically delivering solid long-term growth. Also gives you a variety of different sectors and industries, and you have the likes of Warren Buffett being a big supporter of it. This makes it a very passive investment because you can just sit back and get exposure to the US market as a whole. So when you combine its low cost to invest and its historical performance, you can see why it's so popular. In terms of the future of this fund, a lot is going to depend on your view about whether the US will continue to outperform the global stock market. I mentioned that it's a very passive investment, but you're still making an active decision that you're going to invest into the US market specifically, rather than either other industries or the world as a whole. You've also got to remember that because it's market cap weighted, a lot of its performance is going to be driven by those larger companies. If you wanted a more of a balanced approach, then this next fund is for you. This is the Invesco S&P 500 Equal Weights UCITS ETF. So it invests in the same companies, but instead of being market cap weighted, they all get an equal share. It has an expense ratio of 0.2%. The main benefit of this fund is that it reduces the dominance of those very large companies. But of course, because you're now investing in some smaller companies, that also brings some level of volatility with it as well. Onto a slightly different fund now. So coming in at number 4 is the VanEck Global Real Estate UCITS ETF with an expense ratio of 0.25%. This fund invests globally in real estate companies and real estate investment trusts. It's going to give you exposure to property markets all around the world, spanning commercial, residential, and industrial properties. And similar to the gold fund, it's going to give you the ability to have exposure to real estate without having to buy and maintain physical property. Real estate historically has generally provided a good mix of capital appreciation and income generation in the form of dividends. So if regular dividend payouts are something that you're interested in, then this could be worth looking into. It's also going to offer you a level of diversification because real estate tends to behave differently to your traditional equities and bonds. It will also give you an inflation hedge because property prices and rents tend to increase with inflation. In terms of the future, it could be a really steady long-term investment, but the things that could affect it are things like regional economic risks and regulatory changes. But if you're willing to take on more risk in return for a high reward, then this next fund is for you. So coming in number 3 is is the Vanguard FTSE Emerging Markets UCITS ETF. This has an expense ratio of 0.22%. This fund is going to give you exposure to a wide array of companies in developing economies such as Asia, Latin America, Africa, and Eastern Europe. Of all the funds on my list, this definitely has the highest growth potential, but that does come at the cost of high volatility. It's going to offer you access to economies with rapidly expanding middle classes and industrial bases. It's also going to offer you a level of diversification because developing economies tend not to move in lockstep with your developed economies. And with the low fees of this fund, it offers you an affordable way to tap into that emerging market growth. Of course, there are going to be higher risks with investments like this. They are going to be more volatile and they're going to be more exposed to geopolitical and regulatory uncertainties. But it could be a really good long-term investment if you're willing to ride out that volatility long term. Moving on to number 2 on my list, and this is the Future of Defense UCITS ETF, and this has an expense ratio of 0.49%. This is one of the more expensive funds on my list, and it is quite a niche investment, but it does offer you a high growth potential. This fund focuses on companies at the forefront of next-gen defense technologies. By investing in this fund, you're aiming to capture the growth stemming from increased global defense spending and the modernization of military capabilities. Like I said, it is a very niche investment, and it is going to be closely tied to geopolitical events and shifts in defense budgets. But it is a rapidly evolving sector, and with governments and private companies increasingly investing in advanced defense and cybersecurity, this could be a fund to benefit from. In terms of the future, with global security challenges and an increasing reliance on technology for defense, the long-term outlook is promising. However, you should be mindful of regulatory shifts, political risks, and market sentiment that can impact defense spending. But if you want a more hands-off approach, the last fund on my list is definitely for you. So coming at number 1 is the Vanguard FTSE All-World UCITS ETF. This has an expense ratio of 0.22%. With this fund, you get global equity exposure from thousands of companies from both developed countries and emerging markets, effectively serving as a one-stop solution to international diversification. Index funds have coined the term passive investment because the fund manager is not actively choosing investments to outperform the market. But with all the others on the list, you have to make that decision to invest in that particular region or sector because you think it's going to outperform in the long run. But with a global index fund, it literally is a set and forget investment. You're betting that the world is going to keep on turning. So if you want a truly passive investment, then this is definitely the one for you. Of course, there's going to be other funds that are going to outperform that and they're all going to have their time, but you have to decide whether you're willing to take that risk to decide on a particular region or a particular sector, industry, whatever it is. It is invested in equity, so of course you are still going to be at the mercy of global economic cycles and geopolitical events. So this is still a very long-term investment and you should be having a time horizon of at least 5 years, but you can invest regularly into it without having to think too much about whether it's the right place to be. Thanks for watching, guys. I'll catch you in the next one.